Hey there, financial freedom seekers. Welcome back to Capital Course, where we help you navigate the complex world of investing. Today, we're diving deep into a crucial topic that could make or break your portfolio during turbulent times: safe haven assets. Look around and you'll see why this matters now more than ever. With markets swinging wildly, inflation hitting record highs, and global uncertainty becoming the new normal, protecting your wealth isn't just smart, it's essential. In this comprehensive guide, we'll explore everything you need to know about safe haven investments. We'll cover traditional options like gold and bonds, examine alternative choices like real estate and cryptocurrency, and give you practical strategies to implement these tools in your portfolio. Why safe haven assets matter. Think of safe haven assets as your financial bomb shelter. When markets go haywire, these investments typically maintain or even increase in value. Remember the 2008 financial crisis? While stocks were plummeting, gold prices soared by over 25%. That's the power of safe havens at work. But it's not just about crisis protection. Diversification through safe haven assets helps manage your overall portfolio risk. It's like having insurance for your investments. You hope you won't need it, but you'll be grateful to have it when you do. Traditional safe haven assets, gold and precious metals. For thousands of years, gold has been humanity's go-to store of value. Why? Because it's rare, durable, and universally recognized. During the 2020 market crash, gold hit an all-time high of $2,774 per ounce, while other assets were tumbling. You have several ways to add gold to your portfolio. 1. Physical bullion, coins or bars you can hold. 2. Gold ETFs, trade like stocks but track gold prices. 3. Mining stocks, companies that produce precious metals. Each option has its pros and cons, which we'll break down for you. Government bond, treasury bonds are like lending money to the government. They promise to pay you back with interest. These are considered among the safest investments because they're backed by the full faith and credit of the government. Currently, 10-year treasury bonds yield about 4%. While that might not sound exciting, remember, the goal here is safety, not spectacular returns. When interest rates change, bond values move in the opposite direction, which is crucial to understand for your investment strategy. Cash and cash equivalents. Don't underestimate the power of cash and money market funds. These liquid investments might seem boring, but they provide immediate accessibility and stability. You can choose from 1. Treasury bills. 2. Certificates of deposit. 3. High-yield savings accounts. Just remember, with current inflation rates, holding too much cash can actually erode your purchasing power over time. Alternative safe haven assets. Real estate. Real estate has historically been a reliable hedge against inflation and market volatility. During the 2008 crisis, while residential properties took a hit, certain commercial properties and REITs in defensive sectors actually performed well. You can invest in real estate through 1. Direct property ownership. 2. Real estate investment trusts, REITs. 3. Real estate mutual funds. 4. Private real estate partnerships. Each approach offers different levels of control, liquidity, and potential returns. Cryptocurrency debate. Now, let's tackle the elephant in the room: Bitcoin and cryptocurrency. Some call it digital gold, while others see it as pure speculation. The truth? It's complicated. Bitcoin has shown some safe haven characteristics, especially in countries with unstable currencies. However, its extreme volatility makes it a controversial choice. In 2021, Bitcoin swung from $29,000 to $69,000 and back down again. Not exactly what you'd expect from a traditional safe haven. Implementation strategies. Portfolio allocation. So how much of your portfolio should you allocate to safe havens? Here's a general framework. 1. Conservative investors, 30 to 40% in safe havens. 2. Moderate investors, 20-30% in safe havens. 3. Aggressive investors, 10-20% in safe havens. Remember, these are guidelines, not rules. Your personal situation might require different allocations. Timing considerations. Watch for these signals to adjust your safe haven exposure. 1. Rising market volatility. 2. Increasing inflation rates. 3. Political uncertainty. 4. Economic slowdown indicators. Don't try to time the market perfectly. Instead, gradually adjust your positions as conditions change. Conclusion. Let's wrap up what we've covered about safe haven investing. 1. Diversification is your best defense against uncertainty. 2. Different safe havens serve different purposes. 3. Regular portfolio rebalancing is crucial. 4. No single safe haven is perfect. Use a combination. Before making any investment decisions, always do your own research and consider consulting with a financial advisor. Your situation is unique and your strategy should reflect that. If you found this guide helpful, don't forget to hit that like button and subscribe to Capital Course for more financial wisdom. Drop your questions in the comments below and let me know what topics you'd like us to cover next. Stay safe, stay invested, and I'll see you in the next video.